So balancing and closing accounts, we need to balance on one side and have to bring down the balance. So how does it work? You have the total on one side, let's say debit. Okay, for example, you have one entry on the debit side, so you're going to total it. Okay, of course 5,000 is going to equal to 5,000, and then we are going to make this side equal to this side. So and then this balance is going to come here, and this balance will be the balance carried down and brought down for the next month. It's just like you bought the vehicle for 5,000, let's say, and then you close up your accounts, and at the end of the month you still have that vehicle worth 5,000, right? It's not going to disappear, the value is not going to go up and down. There is another element of depreciation which we will learn later on. That means our value of non-current assets will go down, and the concept is that as we use the item the value goes down, right? It scraps off. But then that concept we are going to have a look at later on. Now there is another example here. For example, we are having a trade payable account. So if we buy something, we debit purchase and credit trade payable, right? We credit trade payable. So when we credit trade payable and they pay us money, okay? When we credit trade payable and we pay them money, not they pay us money, we pay them money because it's payable, we are supposed to pay. What we are supposed to do is we are having a difference of 200. So when we equal it, this side is 400 but this side has only 200, so the difference is going to be the balance carried down. Okay, so I have explained this concept earlier also, that blue items will go in balance sheet, asset, liability, capital and drawings, and this one orange, or let's say brownish, will go in income statement, income and expense. Okay, now only the items that are blue that goes in balance sheet will have balance carried down. Okay, so only the items okay, so only the items that are in blue will have a balance carried down and will go in balance sheet. Okay, if we have an item that belongs to income statement, we close the account by income statement. Okay, we transfer the amount into income statement and there is no balance carried down or brought down here. Okay, so there is no balance brought down, it's just the account is closed. So if we were to have one account in 1st Feb, it's going to be a new transaction. Our account for income statement and expense are going to start from 0. Okay, so there is going to be 0 balance in any of income or expense account. Okay, but if we have any asset or any liability or any capital, we can have balance carried down. Okay, if we have balance carried down, then we are going to have balance brought down. Okay, and balance brought down is going to be the amount that is balance carried down. Okay, so drawings also can have balance carried down, or you can just transfer the amount directly to the capital account. Okay, so this is the concept of balancing and closing account. So there is also a running down system, a running down account system, which we will not be focusing on because it does not assess you in IGCSE, although you have couple of questions in your exam. But how it's done is that if you look at page 56, okay, so you will have the account, but then your debit and credit side is going to be totaled. Okay, so for example, let's say you have your bank account here, right, and then you have your detail, debit and credit, and then here you're going to have balance. So your debit and credit is not in form of T account, it's in form of in this format. Okay, so you can just push this, and what we can do here, it's going to be something like this. Okay, so all the transactions, so let's say if we buy something, let's say we debit bank 200 and we credit sales, let's say 200. So how do we record it here? We write sales because the money is coming into the bank, so now you have a positive balance of 200. Okay, so this is positive. So let's say you have another transaction where you debit purchase and you credit bank 100, or let's say 20, right, 35. So now here you are going to write purchase, and then now you credit from the account, and this you take the balance, you take this amount, you minus from the credit. Okay, and then if let's say there is another debit, you receive the money from trade receivable, so you debit bank and you credit your trade receivable, let's say 400. Okay, let's say 400. So you write here trade receivable, you receive the money, so debit, and then you plus because debit is plus. Okay, so that's the concept of the running down system, but we are not going to focus on this much, but you should know what it is. Let's say if I were to show you what is this, you should be able to answer me. This is running down balance, and what it's doing is debit mean we have a positive balance, and then credit mean it just minus from the balance carried that we have. Okay, so this is the very brief chapter, and we'll be also looking at another chapter now.